We're delighted to have Gustavo Schwenkler of Santa Clara, my old friend, recently back in California, talking to us about news-driven peer co-movement in crypto markets. So I'll mute myself and please go ahead.
All right. Thank you so much. Thank you so much for having me. This is a brand new revision of our paper, and it's very much going to be focused on these news component. And I think that's really an interesting aspect of this market in particular. And this is joint work with my former PhD student, Hanan Zheng, who's now at Fidelity. So, I mean, cryptocurrencies, as you all know, is a big new investment class that has drawn significant investor capital. There are currently around 6,000 cryptocurrencies traded on close to 400 exchanges around the world. The aggregate market cap right now surpasses $2 trillion. Bitcoin on its own is almost $1 trillion of the market cap. And the aggregate daily trading volume consistently reaches above $150 billion. It's a very big and liquid market. And in particular, as you probably all saw this year with Dogecoin, is like these markets are highly volatile and very responsive to information. We have volatilities of around 15%, weekly volatilities of around 15%, and idiosyncratic volatilities of around 10% at a weekly basis. They're highly volatile markets, very reactive. Trading occurs in real time or nonstop. So as an investor, of course, it's very important to understand what drives the co-movement in these markets. So if you're building portfolios or if you're doing risk management, you really want to understand what drives co-variation. Now, the literature so far has posited two channels that drive the co-variation of cryptocurrencies. The first one is now in two RFS papers by Liu and his co-authors. It's kind of a Fama French story. There is kind of common set of risk factors that drive the cross-section of assets, and all assets co-move with these risk factors, essentially. And in particular, they've highlighted a market, a size, and a momentum factor. There's a new paper by Will Kong that also highlights kind of a network factor. So we may have 3 to 5 factors again in this space that drive the co-movement, conditional co-movement in these markets. Now, there's a new paper by Amin Shams that argues that there's an additional source of co-movement because many of these cryptocurrencies are traded on different exchanges. So we often have one and the same cryptocurrency traded on multiple exchanges. And one of the issues is that these exchanges often have geographic restrictions as to what their investor bases can be. For example, in the US, a lot of people trade on Coinbase. In Australia, maybe people trade on other exchanges like CoinJar, for example. And these exchanges have restrictions as to who can invest in these exchanges. So because of that, cryptocurrencies that are co-listed in exchanges with geographic restrictions may be exposed to kind of correlated demand shocks. So say if in Australia something happens, all these cryptocurrencies that are co-listed on CoinJar may co-move, and then this may spread to cryptocurrencies that are co-listed with these other exchanges somewhere else. So we may see kind of the spread of these geographic shocks because of the co-listing in different exchanges. Now, what we argue is that there's a third channel at play in these markets, and that this is primarily a mispricing channel, namely that investors often overreact to information that is reported in news, and that this leads to mispricing across peer cryptocurrencies. So cryptocurrencies that are similar and should move similarly start diverging when there's a lot of information released in these markets and investors are not able to kind of understand what's happening. Now, what I'm going to have is I'm going to have 3 sets of results. The first set of results is going to be primarily focused on the contemporaneous co-movement of these assets. So I'm going to show you that when large idiosyncratic shocks take place, and we define idiosyncratic shocks to be shocks to abnormal returns in excess of risk factors, then the assets that experience these shocks, of course, experience negative performance. This is showcased here in this plot in the bottom, in the middle figure, where we have all these assets that on an event week, which is week 0 here, experience large idiosyncratic returns, large negative idiosyncratic returns. They lose they lose more than 10% on those weeks. Now, there's no significant abnormal performance in the weeks before or the weeks after. These are truly idiosyncratic shocks. But what I'm going to show you is that assets that are cryptos that are peers to these shock cryptos experience abnormal positive performance in the abnormal performance in the opposite direction. So here on the left side of this figure, I have what the performance of assets that I label as peers. I'm going to tell you how I identify peer cryptos. And consistently through many different specifications, we see that when these large negative idiosyncratic shocks take place, peer cryptos experience large positive performance. So on these event weeks, peer cryptos record around 4 to 5% abnormal performance in excess of risk factors. So these peer cryptos move in opposite directions to shock cryptos. In traditional financial markets, we tend to call this a competition effect. Investors move their assets from these shocked assets to peer assets because they believe they're substitutes. Now I'm going to show you that this is primarily concentrated among the set of peer assets that we identify from online news. So the news is reporting about these peer assets, and it's going to be concentrated among those peer assets that are co-listed in the same exchanges, where investors can easily move their funds from shock cryptos to peer cryptos. Now, I'm going to show you some evidence that this is kind of, in a way, an overreaction to the news. These shocks are purely idiosyncratic. They don't reveal any pricing relevant information for these left cryptos here. And still, investors react to this information. So it's kind of an unjustified or unjustified by fundamentals reaction to information. So that's the first set of results. It's purely co-movement. Now, the second set of results is going to argue that this co-movement leads to predictability. Now, because it's a form of mispricing, investors overreact to information that is pricing irrelevant. It takes investors time to realize that they've overreacted to this information. And this slow information processing then gives rise to predictability, because the prices of peer cryptos are going to slowly revert down as investors trade away this mispricing that they've introduced. We find that trading strategies that exploit this predictable reversal of performance have high Sharpe ratios with no factor exposure and statistically significant alphas. And this holds after trading fees. So these are well-performing trading strategies that are based on this predictability. I'm going to show you some evidence that this is due to kind of a slow information processing story. I'm going to show you that when shocks are more easily interpretable by investors, we don't observe this predictability. And if we restrict these trading strategies to the set of assets that have higher information processing speeds, the predictability is shorter lived. So again, this points to the idea that when investors are really paying attention and they can process and digest the information, we wouldn't see the degree of predictability that we see in the data, suggesting that it's sorry.
Is it straightforward to short
So yeah,
one of the peer cryptos?
I'm going to show you that it's not as straightforward. There are exchanges that allow short trading on margin, and we build in those fees as well. But generally, the cryptos that are available for trading for short selling on margin are also more liquid and have higher information processing speed. So I'm going to actually show you that if we restrict the strategy to the universe of cryptos that have short selling, then the predictability is shorter lived. So again, pointing to kind of an information processing story. Does that make sense?
Absolutely, thank you.
Mm-hmm. All right, so the first two set of results are really kind of first highlighting statistical correlations and then arguing for the economic channel that drives the statistical correlation. Now, the final set of results is going to be how we really identify peer cryptocurrencies in the data, because it's not as straightforward to do for cryptocurrencies, and it's also not straightforward to do for other assets. Now, what we do is we use an NLP methodology, so it's a natural language processing methodology, to identify peer linkages across cryptos from online news. Now, the way we're going to do this is we're going to extend a methodology that Frank and I had in a previous paper that we used for stocks by adding an additional layer where we run the links that we potentially identify from online news through a deep learning methodology that is going to tell us whether those links are peers or not. And I'm going to walk you through the details of exactly what I mean with this in the presentation. Now, our methodology is a bit ad hoc. It's a black box machine learning methodology. We train it using hand-labeled linkages that we identify as peers and non-peers. And in cross-validation exercises, we find that the accuracy rate is around 85% for those hand-labeled sentences, for those hand-labeled linkages. And out of sample, more importantly, what we do is we try to see what drives the probability of us assigning a label of peers to two cryptocurrencies. We find in these kind of logit type of regressions that it is more likely that we're going to say two cryptos are peers when they have similar sizes, similar ages, similar factor betas, when they operate in the same industries, or when they're co-listed in similar exchanges, in the same exchanges. Again, pointing that when we say two assets that are peers, this is because they tend to have similar characteristics, consistent with what we would say is a peer. So here, what we really do is we propose a new methodology to identify peer assets from text data. And we argue that using online news, or generally financial news, is a really good idea to kind of identify these relationships that are otherwise hard to identify. In terms of the contributions, we contribute to 3 sets of literature. Now, the first set, of course, is kind of what drives co-movement in these markets. All of the results that I'm going to show you hold after controlling for the common risk factors of Liu et al. And for the correlated demand channel of Shams. And more importantly, what we show is that news reporting can completely change the nature of the co-movement in this market. I'm going to show you evidence that we can replicate the co-movement that Shams establishes among the set of cryptos that are never mentioned in the news. But once these cryptos appear in the news, then investors start paying attention to them and they start changing the way they trade these cryptocurrencies. So this is, I think, an important result, again, which points more generally to the power of financial news to kind of influence co-movement in the market. We're, of course, going to contribute to a huge literature that goes back 20 or 30 years on competition and contagion effects among peer assets. We tend to think about kind of these 2 competing mechanisms at play when we consider the co-movement of peer assets. No arbitrage, of course, tells us that peer assets should always move equally, but we have kind of diverging performance sometimes in among peer assets. Now, a contagion channel is kind of the standard way of thinking about peer assets. When something happens to one asset, investors kind of interpolate that something similar may be happening to peer assets, and therefore they're going to trade in ways that move their prices in the same direction. There's a lot of evidence of contagion effects among peer assets in the equities and the bond markets. A competition story is slightly different because it argues that investors view these peer assets more as substitutes, so that when something happens to an asset, they move their funds to peer assets that may be unaffected by the shocks that are recorded. So most of the times, the difference between a contagion and a competition effect is really driven by how pricing relevant are the shocks that we're observing. Now, what we're going to argue here is that in this market, we're going to identify purely pricing irrelevant shocks, and we're still going to observe competition effects. So contributing to this story that we observe competition effects even in this new asset class after pricing irrelevant shocks. And then finally, we're going to we contribute to the literature that argues how to identify peer assets from alternative data. The most probably the most famous paper here in this space is Hoberg and Phillips in a 2016 journal JPE paper, I believe. So Hoberg and Phillips argue that we can identify peer firms by looking at the similarities in the textual content of the 10Ks. And they built these extensive peer linkages based on this methodology and argue that these peer linkages are more informative about co-movement than, say, ad hoc industry classifications or other kind of manual, human-driven kind of labels of what peer assets are. Now, we argue that something similar can be done with online news. We can use NLP methodologies to identify peer linkages from online news, how the news reports about peer assets, and we obtain, again, more information about co-movement across peer assets by doing this than, say, we rely on ad hoc industry classifications in the crypto space that are provided by some data sources. So that's kind of a very quick overview of what we're going to do. I had built in a little break in here just to take some questions in case you have any, or not, I can just keep going.
Any takers? It's very clear. So
Good. Perfect.
please
All
go
right.
ahead.
All right. So I'm going to jump straight into kind of the data and the empirical framework. For those of you that have worked with cryptocurrencies, cryptocurrency data is very, very messy. There's many, it's very difficult to deal with cryptocurrency data, to be honest. So what we're going to do is we're going to combine data from 3 different sources. We're going to use data from CryptoCompare, which is a big data provider. In CryptoCompare, what we're going to do first is we're going to obtain characteristics of the different cryptocurrencies from CryptoCompare. So say what industries they operate. CryptoCompare provides industry classifications. What type of coin, whether they're coins or tokens, what kind of algorithms they use, when their white papers came out. So just kind of fundamental characteristics of these cryptocurrencies. More importantly, what we're going to do in CryptoCompare is we're going to access their news API. CryptoCompare does something that's very neat in that they collect online news articles that are posted on many different sources online, like Yahoo Finance, Bitcoin.com, and many other different data sources. These are all online news sources. They're not social media sources. So we don't include Twitter or Reddit or anything like that, but we just include kind of articles that either professional journalists write or just amateur journalists write as well. So this is not just kind of the Wall Street Journal or the New York Times. And that news data is available, it's freely accessible and it's very extensive. So we're going to make use of that. The downside to CryptoCompare is that it's not very well maintained in a way when it comes to market data. So their market data is very noisy and has a lot of errors. So instead of using CryptoCompare for prices, we're going to go to CoinGecko to obtain prices, volumes, and market caps for the different cryptocurrencies. CoinGecko is a neat website because it's kind of an open source website where users can correct and flag mistakes in the data. So it tends to have very accurate pricing data. In addition, we're also going to obtain from CoinGecko social media data, which we don't use a lot. So we're not going to use they don't provide the text, but they provide, for example, how many comments were posted about different cryptocurrencies on any given point of time on, say, Reddit and Twitter, and we're going to use some of that information as well. Then finally, we're going to go to Coin API to obtain exchange data. So on which exchanges are all these different cryptocurrencies traded and when they started trading and stopped trading on these different exchanges to be able to control for this correlated demand channel of Amin shops. We're going to consider the 100 largest cryptocurrencies by average market cap during the sample period that we have. And we're going to consider the 100 cryptocurrencies that were alive at some point during the sample period. So it may not necessarily be that all these cryptocurrencies were alive the whole time. The sample period goes from October 1st, 2017 through November 30th, 2020. We can't go back in time much more because CryptoCompare doesn't have news data going back that far. And we could go forward a little bit more. We just haven't done it as part of the revision that we did recently.
Gustavo, can I ask 2 questions? They're easy ones. One is why the focus on weekly data?
Primarily to be able to compute idiosyncratic volatilities. So we were going to define idiosyncratic volatilities as the standard deviation of abnormal returns within the 7-day window. That was the only thing. We've kind of thought about looking more high frequency as well into this.
It's available, right? High frequency.
Was that it, Lisa?
Sorry, I think I
is
lost you, or
available,
you lost
yeah.
me for a moment. High frequency data is around, right?
Daily data is around for sure. I think hourly data is around. I'm not quite sure how far back in time we can go in on high frequency data. Was also an issue that when I got this data, I was still at Boston University, and just getting data was just a pain out there.
Mm-hmm.
So potentially there's access to data that I can get access to that I just have to pay for, and I can just do that now.
Yeah, great.
That was very difficult to do before. Yeah.
Second question is, what's a stable coin? Sorry if you already explained that.
Oh yeah, stable coin. We define a stable coin as anything that's pegged to the US dollar. So yeah, so there's various cryptocurrencies that have a fixed exchange rate with respect to the dollar. So those don't have any volatility, so we kind of exclude those.
Got it.
Yeah.
Okay, thank you.
I've got a question about data. So these cryptocurrencies are traded in blockchain, I assume. So isn't there, I mean, it may be very costly to access, but isn't there in principle a complete record of every transaction with date stamps that you could get out of the blockchain ledger?
Yeah, definitely. And I know people that have done that. I haven't. I'm not that technically savvy. I should probably know how to do this. Probably data that is accessible somehow for fees.
Yeah, I mean, it might be extremely messy to access, but I think in principle
Yeah.
it should be available.
But the cryptocurrencies that trade, they're not always the ones that change the ownership. So there's a lot more trading data than there are settlement data, and the settlement data is the ones that you can get from blockchain.
I see.
And I would imagine that a lot of this co-movement and sort of alpha would be coming from trading without kind of really changing the ownership in the end, similar to how market making is done in stock exchanges, but we will see.
So you're saying if I buy
That's a really interesting
currency,
comment. Yeah.
then basically I'm dealing with a broker on the other side, and they move it out of their inventory into my account with them, but they don't actually transact it in the blockchain. Is that correct?
Yeah, pretty much, right? So like I haven't done much research on cryptocurrencies, but I've done some, and so my conjecture, and I hope to see some proof in this presentation, is that the trading in cryptocurrency, because it's unregulated, it's probably very similar to how these market making transactions are done. So majority of accounts who trade cryptocurrencies should be like equivalent of broker dealers, right? So in the NASDAQ, we used to have a problem with data when there would be double counting volume, because there would be like a principal transaction on both sides, and that would be hitting the tape, and they have eliminated this. Like sometimes, I'm pretty sure in cryptocurrency this going on, and it's not even double, but probably 20 times counted between, the same owner. And it would be interesting to see what the kind of non-broker dealer equivalent participation in these trades are, but I don't think there are data on that. Maybe there are from exchanges, but exchanges are not conducting business on a blockchain. The accounts are, and the accounts could just trade with an exchange and record end of day the transaction that they basically the net result.
Yeah, let me add to that. It's my certainly non-expert understanding is that blockchain was a particular feature of Bitcoin and other cryptos that want to emulate it. But Ethereum, for example, I don't believe settles through a blockchain. A blockchain represents a lot of issues. Its main advantage being that a distributed ledger is robust to a variety of interruptions.
Yeah, that's true. I mean, I think the characteristics would carry the way the cryptocurrency has been exchanged. Is that right,
Yeah.
Gustavo? Yeah.
Yeah, I think this is a really good comment. I actually know that some exchanges do keep inventory of some of these coins. So I could see potentially this just being kind of a portfolio adjustment. And I'm going to argue at times that that might be what's going on here. That's a
So
really
there's
good comment.
definitely less, like if you look at the Bitcoin transaction number, there's
Yeah.
significantly less recorded transactions than there are reported trades. So there's definitely,
Yeah.
this is one way to look at it as well, but there's many, so exchange is one participant, right? There are many other participants in cryptocurrency markets at the moment, and some of them could be just like large high frequency trading accounts or something like that.
Yeah, any change of address would have to go through the blockchain though. So if,
that's right.
Yeah, absolutely.
Mm-hmm.
But that's a really good comment. I'll actually take a look at that. I believe there's data on this, so I can take a look into that. All right, so I'll keep going. Summary statistics. The more important thing to take a look at in this is that it's a very heterogeneous market. We have hugely diverging volatilities. We have cryptocurrencies that are very stable, and then cryptocurrencies that are hugely volatile. So in order to make proper comparisons across cryptocurrencies, what I'm going to do is I'm going to standardize most of the variables that I'm going to be considering using a 60-day rolling mean and variance. So everything is going to be standardized with respect to its recent history. Then the other thing to keep in mind is that I only consider 100 cryptocurrencies in my analysis, but these 100 cryptocurrencies cover over 95% of the total market cap. So this is pretty representative. I'm gonna skip this, not much to say there. And
can I ask one more question if you go back a couple of slides?
Yeah.
So the mean weekly return is negative.
Yeah.
That's about 15% a year.
So this is kind of the so this is the way to interpret this is the average of average weekly returns. So I take for every one of these cryptocurrencies their average return over their life sample. And then what I report here is the average across all the 100 cryptocurrencies that I have in my sample. So
the sample was from 2017 to 20, right?
That's right, yeah.
So there was it was like negative return over that period of the class. Yeah.
Exactly. We had the big, and I can show you here. We have this top left plot has kind of the cumulative market return. So we had a big crash in 2018, then a comeback, a crash again, and a comeback. So some cryptocurrencies remained over the whole sample period, but some kind of died out as well. So that's probably why this negative return is in there. Yeah. What we're going to do is we're going to build factors for the market. We're going to have the market factor. We're going to build a size factor, which is kind of the difference between the top decile of the top decile portfolio minus the bottom decile portfolio in this market according to market cap. And then I'm going to build a momentum factor, which is the difference between the top and bottom decile of prior week performance portfolios. And I'm going to build abnormal returns in excess of these three risk factors and idiosyncratic volatilities over a week, which is the standard deviation of those the daily abnormal returns in these windows. So again, keep in mind that these are very heterogeneous cryptocurrencies. Something like a Bitcoin has very small idiosyncratic volatilities because it commands so much of the market. But a lot of these smaller, less liquid cryptocurrencies have very large idiosyncratic volatilities. So we're going to standardize everything to make sure that we can make comparisons across these different assets. Now, the bigger contribution, and not just dealing with data, is kind of how we identify cryptocurrencies, cryptocurrency peers. And what we're going to do is we're going to extend our previous methodology to do this by reading online news. So the way our methodology works, the original methodology was basically the first 4 steps here, is we took all these articles that we obtained and we run them through our algorithms. In the first step, what we're going to do is we're going to run each article through a standard NLP package known as the Stanford Core NLP. And in particular, we're going to run this through something that's known as the named entity recognition algorithm that identifies which words in the text are nouns and which ones of those nouns refer to named entities. Named entity could be a government, an institution, a company, an asset, a country, a geographic region. So there's many different types of named entities. So what we do is we develop our own machine learning methodology to separate which one of these entities are actual financial assets and which ones are other entities that we don't care about. In the third step, what we do to make sure that these financial assets we identify are correct, we match them with a data source that contains all the financial assets that we care about. In this case, these are cryptocurrencies, so we're going to match with the cryptocurrencies that are available on the CoinGecko database, and that's going to provide the matching. Then once we've identified where our cryptocurrencies mentioned in the news articles that we collect, we're going to say 2 cryptocurrencies are potentially linked if they're mentioned in the same sentence of an article. In our previous paper, Frank and I go through a lot of work trying to argue that most of the economically relevant information about linkages across assets are communicated within sentences rather than across sentences. So we feel fine focusing just on this very restrictive sentence-based linkage. Now, our original paper kind of stopped there, and then we had a bunch of these linkages across assets, but we could not really tell what kind of linkages these were. So what we're going to do in this paper is we're going to extend this methodology by labeling what the linkages are. And the way we're going to do this is we're going to run these sentences where at least 2 cryptocurrencies are mentioned through a deep learning model that was facilitated by a new Amazon service called Gecko that Sanjeev actually developed. He graciously provided us beta access to this. Now, the way this works is that we're going to take these sentences and construct a numerical representation of the sentences, so a vectorized version of these sentences through something that is known as BERT. And then those numerical representations, we're going to run through a deep learning model that is going to classify these sentences as describing a peer relationship or a non-peer relationship based on kind of the words in these sentences, the positioning of the sentences relative to each other, the connotation, and all sorts of other characteristics of the sentences that we use. We're going to run this methodology through 200,000 articles that we obtained from CryptoCompare, that were collected from Yahoo Finance, Bitcoin.com, CoinDesk, the blog, and so on. In the paper, we have kind of a big description of what these data sources are. Just to give you an idea of how this works is we're going to have all these different sentences in our article extracted from the articles where we identify at least 2 cryptocurrencies. We're manually going to label 460 of these sentences as describing a non-peer or a peer relationship. As you can imagine, many of these sentences describe just financial performance of the cryptocurrencies. For example, this first sentence says what the prices of Bitcoin and Ethereum were. Some sentences describe just kind of the performance, the returns of the cryptocurrencies. And some sentences just describe kind of quote and base currencies in the market. All of those type of sentences we're going to label as non-peers. And we're going to focus primarily on the sentences where we learn something about the characteristics of the cryptocurrencies. So for example, there are sentences that explicitly say these are competitors to these cryptos are competitors to these cryptos. We're going to say that's a peer relationship. There are sentences that describe what kind of cryptos these are. For example, this sentence here says that HT and OKB are both tokens issued by exchanges. There are sentences that describe similarities in these cryptocurrencies or differences in the cryptocurrencies. All of those we're going to label as peers. And then there are a lot of sentences that describe fork relationships. We're also going to describe those as peers. So we're going to have all the data of what we label as peers and non-peers we kind of make available online. And we are going to train our model based on these hand-labeled sentences. In cross-validation exercises, we find an accuracy rate of around 85% on these hand-labeled sentences, suggesting that the algorithm does really well at identifying what is a peer relationship and what is a non-peer relationship. Now, to further validate that this labeling is actually economically meaningful, sorry, before I go there, this is kind of what the network looks like if we were to plot the network of these linkages, peer linkages we identify. It has what Acemoglu et al. Would call a star architecture, whereby we have a very strongly interconnected core of assets. At the center of the network is Bitcoin, Binance, Ethereum, and all these other assets that are just bigger and more prominent. I'm going to show you later on that this is what we generally observe in this data. And then we have on the periphery kind of smaller cryptos that are linked to these other assets. So we never really make use of the network on its own. It's an interesting object to study on its own, but we're not going to do this here. What we're going to do is we're going to consider linkages between two cryptos, say here KTUM and BTM, and we're going to consider what happens when we observe this linkage between both of these cryptos and when we don't. That's kind of what we're going to be exploiting. So we're just going to be considering pairwise linkages rather than the whole network. So again, to understand that these are economically relevant linkages, we're going to run a logit regression where we consider what drives the probability of observing a link between two cryptocurrencies. We're going to do this both unconditionally, what drives the probability of ever observing a link between two cryptocurrencies. And we're also going to do this conditionally, what drives at any given point of time the probability of observing two cryptos being labeled as peers. We're going to the exogenous variables in this regression are going to be characteristics of the individual cryptos in the pair, characteristics of the link that we observe, like for example, are these two cryptos in the same industry? Are they listed in the same exchanges? Is one of them Bitcoin or Ethereum, just because these are such big assets? And more importantly, we're going to consider the differences between the characteristics of these two cryptocurrencies. If we observe, if these linkages actually were to reflect peer assets, then we would expect that the smaller the differences, the higher the likelihood of observing a link between these cryptocurrencies. And that's what we're going to test in these regressions. We include several fixed effects to kind of control for things that we know about. So I'm going to show you what we obtain. We find that because these are linkages observed from the news, it is more likely for us to observe a link between cryptocurrencies that are large, that have large trading volumes, that are popular online, or that have positive performance recently. Now, this is something that we know already from financial news. We know that the news is biased towards reporting about bigger assets and popular assets. So this is not something that's necessarily out of the ordinary. We would have expected this. And that's essentially why we observe Bitcoin, Ethereum, and all these big coins in the center of the network that I showed you before. But what's more important is that we observe that our regression suggests that the likelihood of observing a link between two cryptos is higher if the two cryptocurrencies have similar ages, if they have similar market cap, if they have similar market betas, they have similar size betas, if they're similarly popular in online news, if they operate in the same industries, or if they're listed in the same exchanges. So this is pointing, sorry?
Gustavo, market beta to which market?
To the Bitcoin, the crypto market, not.
And it's like a market cap weighted thing.
Yeah.
Okay.
Yeah. So what do these regressions tell us? Well, it's more likely that we're going to say two assets are peers when they share similar characteristics, which is intuitively what peer linkages should really reflect. So these results really just validate that the linkages that we establish are consistent with what we would consider to be peer linkages in this market. All right. I was going to wrap it up here briefly for questions in terms of the methodology and the empirical setup, if there's any, and otherwise I can just continue.
Yeah, could you say a little bit more about the independent variables there? I'm not sure I quite, let's say we have, take Ethereum, what would its vector of features be?
Right. So this is kind of a regression based on linkages. So say if we link Bitcoin and Ethereum, say
Okay.
crypto I is Bitcoin, crypto J would be Ethereum, and we would include as independent variables, depending on how we do this, whether it's conditional and unconditionally, the number of times these cryptocurrencies are mentioned in the news, the logarithm of that.
Okay.
The age of those cryptocurrencies, the log market cap, log trading volume, their realized return, either on average across the sample or conditionally in 1 week. The volatility in that week or unconditionally across the sample, the market beta, market size beta, or momentum betas, those are kind of invariant across the sample. They're estimated once for each crypto. And look, Alexa, Amazon provides a measure of how popular different websites are on their on online searches. So a lower Alexa rank means that these sites are more popular online. People search for them a lot. So we find
and then you take the differences across these features and do a logistic regression for peer or non-peer.
I take the absolute value of the differences to be for identification purposes. Yeah.
Thanks very much.
Yeah, absolutely. All right. Any other questions? Okay. So this is kind of the setup. This is what we're actually going to use. And what we're going to do next is we're going to run our empirical analysis. So once we have this network, what we're going to consider is we're going to build essentially this network once every week based on the news reported in that week. And we're going to try to observe where in this network do shocks occur. And if, say, GLM here is shocked, what cryptos is GLM linked with, and how do those linked cryptos perform in the week when we observe the shock and in the weeks after the shock. So for this, we need to define what a shock is. And we're going to say a shock for now is going to be a realization of abnormal returns that lies in the bottom decile of abnormal returns across crypto and times. We feel that this is fine because we are not really considering abnormal returns. We are considering standardized abnormal returns. So they're comparable across all cryptos. And there shouldn't be forward-looking kind of biases because once they're standardized, everything is centered anyways. So we're not kind of moving away. We're not kind of introducing any sort of biases, we believe. But we also should have results where we just get rid of the standardization, and we can show you what happens there. We're going to consider negative shocks. So we're going to consider abnormal returns that lie in the bottom decile of the distribution. In the paper, we also have results for positive shock that lie in the top decile of these abnormal return distribution. And then we're going to keep track of the event. So we're going to say Bitcoin was shocked on the week of October 3rd of 2020. We're going to consider what cryptos do we identify as peers of Bitcoin in that week based on news from that week. And we're going to keep track of the performance of these different cryptos. We're going to primarily run, this is kind of the distribution of shocks in the data. We observe around 200 shocks that affect around 40 cryptos over 110 distinct weeks in our sample. The distribution of shocks is roughly uniform over time, except that in Q2 of 2019, we observed much more shocks. We attribute this primarily because Q2 of 2019 was a low volatility period, so that even small shocks based on our standardization could be interpreted as large after the standardization. And what we're going to do is we're going to do diff and diff regressions, where we consider kind of the excess abnormal return performance of the different cryptos in and around event weeks. We're going to consider 2-week windows around events, and we're going to have a treated indicator, which is all the treated cryptos are going to be those that we identify as peers in that event week. And the event indicator is going to be either the event week itself or the event week plus the 2 weeks after the event week to control for potential lags. We're going to include crypto fixed effects to account for the heterogeneity in the market. We're going to include shock crypto fixed effects to account for the fact that shocks to Bitcoin, for example, may be very different than shocks to Dogecoin. And then in addition, we're going to have day and industry interacted fixed effects to control for heterogeneity in these crypto or omitted variables that we may not have accounted for. Now, what we really care about in these diff regressions, of course, is the interaction of the peer indicator and the event indicator. And in particular, we care about the sign of this indicator. If the sign of the coefficient is positive, then what this tells us is that when one asset experiences a negative shock, peers of those assets experience also negative shocks. So this would point to kind of this contagion channel that I was talking about before, whereby investors extrapolate that peer assets experience similar performance, even though these shocks are idiosyncratic in nature. A positive sign for this indicator, interaction indicator coefficient, would suggest that when assets experience negative performance, peer of those assets experience positive performance. So this would point to this competition effect that I've been highlighting earlier. And we're going to run this regression in the data. What we find is outlined here. The diff and diff coefficient that we care about is this peer times event indicator. And we find consistently across different specifications that it's statistically significant and positive. Now, these regressions are run on standardized abnormal returns. In nominal terms, what these regressions tell us is that when shock cryptocurrencies experience shocks, they record excess abnormal returns after risk factors and after characteristics of around minus 15%. Peers, or the cryptos that we identify as peers of those cryptocurrencies, experience excess abnormal returns of plus 4.5%. So this is statistically significant and economically significant performance. Now, what this shows you really is just kind of statistical correlation so far. We identify a set of cryptos that consistently move in opposite directions, but what this doesn't really tell us is why we're observing this. So what we really want to do is try to understand what's driving this co-movement across peer assets. And what I'm going to show you is that what drives this abnormal performance is that investors overreact to pricing irrelevant information. Now, how am I going to do that? The first step to show this is that I'm going to show you that the co-movement we establish is concentrated among shocks that are opaque. We're going to define shocks as being informational in nature when they reveal information to the market. And we're going to identify informational shocks in 3 different ways. We're going to say a shock is informational when there is abnormally large information production about shock cryptos. So say if in the event week, the number of times shock cryptos appear in the news lies in the top decile of the distribution of that, of log mentions in the news across crypto and time, we're going to say that shock is informational in nature. Alternatively, we're going to say a shock is informational in nature if there's abnormally large trading volume for shock cryptos. So there's a lot of things happening and there's a lot of information being disseminated. Or we're going to say that a shock is informational in nature when the idiosyncratic volatility of shock cryptos are large, abnormally large in the event weeks. Now, what we consistently find is that the co-movement we established is concentrated for shocks that are not informational in nature. So these are shocks for which there is information production and news about shock cryptos, but not abnormally large. There's trading volume for shock cryptos, but not abnormally large. And idiosyncratic volatilities are large, but not abnormally large. So these are shocks that are more opaque in nature and are harder to interpret by investors. Now, additionally, we're going to show that the co-movement we establish is concentrated among cryptocurrencies, among peer cryptocurrencies that are smaller than the shock cryptos that experience the cryptos. Now, in the traditional financial markets literature, we know that smaller assets tend to be less opaque. They tend to have slower information processing speeds. Investors don't pay a lot of attention to these smaller assets, so they naturally will face slower information processing. We find that consistent with this this conjecture, the co-movement is concentrated among the set of peers that are smaller than the shock cryptos that experience the shocks. So again, something happens. These shocks are idiosyncratic in nature. They're reported in the news. There's trading activity, but there's not super high activity. And investors that are invested in these smaller peers kind of overreact stronger to that information because they don't quite understand what's happening. Now, the next thing that I'm going to show you is that this is really an overreaction to news reporting. So that this is not just investors reacting out of the blue to something, they're reacting to what is being reported in the news. We're going to break down the set of peer assets into peer assets that share other linkages with each other. For example, we're going to consider peer assets that are co-listed in same exchanges. These are these top two set of peers. And then the bottom, we have peer assets that are not co-listed in the same exchanges. Sorry, no, we're going to consider cryptocurrencies that are co-listed in the same exchanges and that operate in the same industries. And we're also going to consider the opposite of those. So cryptocurrencies that are not co-listed in the same exchanges or do not operate in the same industries. And what we find consistently is that the co-movement we outline is concentrated among peer assets that we identify from the news that are co-listed in the same exchanges. So it is among these news identified peers that are co-listed in the same exchanges that we observe this positive performance. In contrast, if we were to consider non-news peers that are co-listed in the same exchanges, we would replicate the finding of Amin Shams. Amin Shams outlines that assets that are in the same industries and are co-listed in the same exchanges tend to experience contagion. And we find that that is the case as well in the subset of peer assets that we consider that are not co-mentioned in the news. So it seems to really be that the news reporting changes the co-movement that Amin Shams kind of established in his paper. We find that these cryptocurrencies that we identify as peers from online news tend to have more information production, so they appear more often in the news. There's some information being produced about these specific cryptocurrencies that we identify as peers. And then ultimately, investors actually react to that information. We find that the cryptocurrencies we establish as peers and that are co-listed in the same exchanges experience abnormally high turnover when events happen and the weeks after events. So investors understand something happened, there's a shock, there's information being produced about these peer assets, and they ultimately react to this information. They move assets from these they move funds from these shock cryptos to these co-listed peer cryptos. And ultimately that leads to this co-movement. So overall, what these results suggest is that investors overreact to news reporting and that they move their funds essentially from shock cryptos to peer cryptos, and that leads to this competition effect that we outlined.
Doesn't it also suggest that investors have a more robust commitment to cryptocurrencies as a market than to individual cryptos? When there's a news shock, they don't move into gold or move into cash. They move into similar cryptos that investors naively believe will not suffer from the same event.
Yeah, that is a good question. I have anecdotal evidence of this. I guess I have anecdotal evidence and then more concrete evidence. The anecdotal evidence is that, yes, there is very strong crypto believers that are invested in cryptos. They don't move their cryptos easily out of crypto. That I definitely see being the case. The other evidence that I would have of this, and I would have to look more into the data, is that it's very easy to move funds from one cryptocurrency to another cryptocurrency within an exchange. That can happen within seconds. But it's very hard to actually move funds out of a cryptocurrency exchange. That takes multiple days generally. So if you wanted to say move from cryptocurrency to gold, then you have to generally move the funds out of your exchange, and that just introduces transaction frictions. Yeah.
Thank you.
Yeah.
Suppose I want to move coin into the blockchain so I can spend it without any government observation of it. Maybe it's for an illegal purpose. How do I do that, and how long does that take?
It depends on, once you're within an exchange, it's all very easy. So say you have an account on Coinbase, you can transact across cryptos within milliseconds.
No, but I
That
want to
is
send,
very, very easy, but you have to get approved.
I want to send money to a drug dealer
Yeah.
and get drugs.
That
Can I do
generally is
that?
not, it's very costly.
Because the
generally.
exchanges are auditable by the government or report or something like that. Is that correct?
No, not all exchanges are auditable by the government.
I see.
Coinbase is now publicly traded, so they are.
Mhm.
Bitcoin, for example, is not. Binance, is not.
Mhm.
So that's why I was saying, I know that several exchanges, for example, Kraken is planning to go public. There are other exchanges that are aiming to go public, so they're kind of sticking more to reporting and kind of regulatory compliance. But there's many exchanges, that don't. And there, it's easier to do kind of these transactions. The only thing is that doing cross-exchange transfers is very costly and difficult. It takes many days. It's often associated with fees, so it's not as easy to do. But generally, I would imagine that this happens more likely on exchanges that are smaller and less transparent, where there's no kind of like oversight.
I think that the general pattern is not liquidating your Bitcoins in order to pay your drug dealer. It's transferring Bitcoins to your drug dealer, who then liquidates them in the ordinary course, in a conventional manner. And then it becomes very hard to trace the, I believe, extremely efficient transfer of Bitcoins from one account to another. The real issue is when cash comes into Bitcoin, tracing its source or other cryptocurrency. And that, I gather, is very hard, which is one of the attractions to a certain cohort of crypto users.
And you can also kind of like whitewash some of these transactions just by transferring them in like circles and going back and forth through addresses, but it's just costly. It's time intensive. It's costly. It is all traceable. It's all in the blockchain, but it's just very hard to trace ultimately. Okay, good. So overall, we got investors overreact to information that appears in the news. This is really a news-driven effect. It leads to mispricing. If among the set of peers that are not in the news, we actually observe contagion, which is the more intuitive thing that we might expect based on previous papers. We find that this is very robust. We find that the results hold after excluding shocks to Bitcoin or Ethereum, which are the biggest cryptos in the market. And they also, and we find completely different results if we don't do the standardization, suggesting that this is also not driven by the smallest coins in the market that may have the largest idiosyncratic volatilities. This is really across the spectrum, something that we observe. We find that the results hold regardless of whether shocks are exogenous or endogenous. the effects are stronger when the shocks are exogenous in nature, say something completely unexpected happened versus just price movements. But again, this suggests that investors do not really process fully what these shocks are and how they should affect prices. We run placebo tests where we randomly link cryptocurrencies based on whether fully at random, whether they have similar sizes or similar market performance. And we find that the effects are concentrated among the peers that we identified. These are not random linkages that the news reports on. There's some informational content in there. And we find directionally equivalent, albeit weaker results when we consider positive shocks rather than negative shocks, which is consistent with behavioral theories that tell us that investors overreact more strongly to negative shocks rather than to positive shocks. We also consider alternative regressions in the paper and find negative conditional cross-correlation in returns rather than these kind of diff and diff kind of effects, again, consistent with what we've established here. So overall, this seems to be a very consistent finding. When these large idiosyncratic shocks take place in the market and the news reports about them, investors have a hard time understanding what's going on, and they overreact to the information. Right. Any questions on this so far?
I have a question about the peer relationship. It seems like you're doing it dynamically using 1 week news. So
Yeah.
how stable are these relationships week to week and over the course?
They're relatively stable. I don't remember the numbers. I think we have them in the paper. They're relatively stable, but there is kind of a timeliness component to this. So investors really react to the contemporaneous information that is revealed in these linkages. When we kind of do the unconditional linkages, the effects are much weaker again, which again points to this kind of like it's an overreaction to information that is revealed at that point of time rather than something that investors already understand. Does that make sense?
Yeah, it does. So my second question would be like, have you done a test on like Dickey Fuller and just see what the co-integration between these peers could be based on just prices alone, and is this support or reject your kind of current peer classification methodology?
So we haven't done co-integration studies. We did mostly this kind of logic regressions as to like what drives when we will observe a link between cryptocurrencies. I mostly talked about this kind of unconditionally, but we also do this conditionally. We don't necessarily find a lot of association with prices necessarily. We find that it's mostly driven by just size effects, really, honestly. But I can dig a little bit deeper into that.
Thank you. Yeah, it does. Thanks.
Yeah, I'm writing that down. All right. So in the last couple of minutes, what I want to talk about is the predictability component of these results. So what we argued is that this is mispricing that occurs because investors overreact to shocks. And if it's truly mispricing, then we would expect, of course, that prices would adjust eventually. So what we should expect if this is mispricing is that the prices of these peer assets that are mispriced are going to revert back down. And this figure here shows that roughly. What we have here is the cumulative realized returns of different sets of cryptocurrencies in the weeks after a shock. In the bottom left plot, we see here shock cryptos. They experience minus 14% exit returns, and those basically take a very long time to catch up with the market, which is plotted here in red. On the right-hand side, we have basically these assets that I showed you experience contagion. So these are the shams kind of linkages that we identified, which are assets that are in the same industry and in the same exchanges. They experience contagion on the event week, but then basically this is not persistent over time. The performance of these assets in the market is very similar in the weeks after. The same for all other cryptos in the market that we identify. But these assets that we identify as peers and that are co-listed in the same exchanges revert back down and catch up with the market at a faster rate than these other assets. So at this figure graphically, all it tells us is that there is some predictable reversal. And now what we want to do is we want to measure and quantify that. Now, the way we're going to do that is we're going to build trading strategies that are going to short sell on every event week all the cryptocurrencies that we identify as peers of a shock crypto and that are co-listed in the same exchanges as a shock crypto. We're going to bet by doing that the prices here on this event week are going to kind of come down in the weeks after an event week, in the weeks after a shock. To keep the market, to keep the strategy market neutral, because this is kind of performance relative to the market, we're going to go long on Bitcoin, which is a proxy for the market in this market. And then we're going to keep these long short positions open for several weeks after an event. These are equally weighted strategies. So because we keep the positions open for several weeks, we're only going to be able to invest a fraction of the available funds on any given point of time. And we take that into account. Now, what we find is that the strategies that hold the position open for at least 6 weeks have statistically significant alphas of at least 50 basis points per week. The strategy that keeps these positions open for 12 weeks has the highest cumulative return of around 230%, a Sharpe ratio of 2.2, an alpha of 70 basis points per week with no market size or momentum exposure. These results hold after accounting for the trading fees that Kraken charges to trade on margin. So we include a 2 basis point fee to open a short position, an 84 basis point fee per week to maintain a short position open, and a 50 basis point bid-ask spread, which is relatively conservative in this market according to papers that have come out. So these are profitable strategies, but more than anything, more than this just being profitable, what this tells us is that there is indeed predictable reversal, because by short selling these cryptocurrencies, we can actually generate significant alphas in excess of risk factors. So this is reversal that is not driven by fundamentals. Now, what we want to do a little bit more digging on is trying to understand whether this is really an attention constrained story. Because so far what I've argued is that there is overreaction in the event weeks, and that leads to co-movement, and it takes investors time to realize that they've overreacted, so that leads to predictability. And we want to kind of push this a little bit further to flesh out whether this is the right mechanism at play here. We're going to do 2 experiments to further validate our conjecture. The first is we're going to consider the cumulative performance of the different set of cryptocurrencies in response to shocks that are more that are not idiosyncratic. So we're going to consider shocks to total returns rather than abnormal returns. These total return shocks may include shocks to the different risk factors, so they may be informative about something that affects all cryptocurrencies. And consistent with that, we find actually different results. We find cross momentum rather than reversal after total return shocks. Now, if you're familiar with the literature on the co-movement of stock peers, that literature generally tends to document cross momentum. When something happens to a firm, firms that are similar to that firm experience also contagion initially and then momentum, so that this kind of contagion lasts a couple of weeks. And we find some evidence that is consistent with this cross momentum phenomenon when we consider shocks that are not idiosyncratic in nature. So what does this tell us? More than anything, this tells us that when shocks clearly reveal pricing relevant information, investors react consistently with what we would expect. But when the shocks are not clearly pricing irrelevant and it takes investors time to figure this out, then they're going to react inappropriately one may say, and therefore lead to mispricing. This is one first kind of evidence suggesting that this is the co-movement we established primarily is driven by overreaction. And then the second set of experiments we're going to run is going to be analyzing the performance of the trading strategies among a subset of cryptocurrency peers. And in particular, we're going to consider cryptocurrency peers that have faster speeds of information processing. For example, I talked about this briefly before. Short trading, short selling can only happen on certain exchanges. Kraken, for example, is one of them. Kraken is one of the largest exchanges in the world. I think the second or third largest at this point. And they make available short trading on margin for only the set of the most liquid cryptocurrencies in the world. So we would posit that the cryptocurrencies that are available for short trading on margin on Kraken are liquid. They have a lot of institutional trading potentially in those markets. Therefore, the speed of information processing should be faster among these set of cryptocurrencies. We also consider the set of cryptocurrencies that are large, the set of peers that are larger than shock cryptos. Larger peers generally tend to be more liquid. And again, more liquid assets tend to have faster speeds of information processing. So we would again posit that the strategies that are restricted to these subset of cryptos face naturally higher speeds of information processing. Now, why is the speed of information processing important? Well, if investors have faster speeds of information processing, they will recognize faster that they have overreacted to pricing relevant information. So that these trading strategies that we build should have lower performance for longer holding periods and higher performance for shorter holding periods. The uncertainty should basically be resolved earlier when there is faster information processing speed. And consistent with this, we find that indeed, when we restrict the trading strategies to these subset of peers that have faster information processing speed, we find higher Sharpe ratios for shorter holding periods and lower Sharpe ratios for longer holding periods. So when investors pay more attention, the predictability we detect is not as persistent as when investors pay less attention. So again, this points to kind of information processing constraints being determined or giving rise to kind of this predictability. All right, that brings me to the end of my presentation. So what do? We first document co-movement among a very specific set of peer assets in cryptocurrency markets, and namely the set of peer assets that investors identify as peers from online news and that are co-listed in similar exchanges. We find that the co-movement is alive after controlling for common risk factors and correlated demand shocks, and we suggest that this may be driven by attention constraints. Investors do not realize that they're overreacting to information that is not pricing relevant. We then establish that this mispricing gives rise to predictability. Trading strategies that exploit the predictable reversal of performance have high performance after accounting for fees. And then finally, we use online news to identify peers using an NLP methodology that we developed. That's what I have. Thank you so much.
Thank you. That was really a beautiful talk, Gustavo.
Thank you.
I wonder if there are any final questions from the audience. Had quite a lively discussion so far.
I'd just like to confirm, you probably said this, I know you referred to an assumption about trading costs, but the 230 some basis point, like 238, was it percent? Yeah, 230.11% is after the assumed fees. Is that right?
That is correct. Yes. Yeah.
Thanks. Very impressive.
Yeah, I mean these are hugely volatile markets. So that's Yeah. I mean, more than just as being like a profitable trading strategy, it's just kind of incredible, really, that there's persistence in this predictability for this long. That's just really, really insane.
The drawdowns are kind of a killer though, right? I mean, volatility, I wonder if that's the perfect measure of risk for this market.
I agree. Yeah, absolutely.
Okay, any final questions then? Well, thank our speaker. It's really great.
Thank you.
Gustavo, can we post your slides and a recording on our website?
Absolutely. Yeah.
And any papers you'd like as well. So Wu-Jin, could you
Yeah.
please work with Gustavo to get all that stuff posted? And I will write a follow-up email. Next week, we have a talk that's a little bit different from what we usually
right.
get. Vic Khanna of University of Michigan, he's a law professor, and I think he will be talking, his title's not posted yet, but I'm guessing he's going to be talking about ESG. So won't guarantee that, but please do watch the website for Vic's announcement. And Gustavo, thank you again. That's really great. I'll be sending you a note later this afternoon. Thanks,
Absolutely.
everyone.
Thank you.
And have a
Thank you.
wonderful, wonderful week.
Thank you.